Most Canadians think they are saving money. They are not. The average Canadian saves about 5% of their income. Asterisk the wealthy save 20% or more. That gap is not an accident asterisk. It is not about luck. It is about a mistake almost nobody talks about. Here's something that might shock you. At that rate, most Canadians would need over 40 years just to build a basic retirement cushion asterisk. The wealthy reach the same number in under 15. Same country, same economy asterisk. Completely different outcome. If you have ever felt like your paycheck disappears before the month ends, this video is for you. Stick around, because by the end, you will know exactly why this happens, and what to do about it. If you're interested in fixing your financial life instead of just watching it happen, consider subscribing, because that's exactly what this channel is built for. Let's zoom out first. Canada's cost of living has climbed fast. Inflation hit decades-high levels in recent years. Interest rates rose just as fast asterisk. Mortgages got more expensive. Groceries got more expensive. Even a simple dinner out costs noticeably more than it did 5 years ago. In this environment, saving money feels almost impossible for many families. Many feel like they're falling behind no matter how hard they work. Asterisk, but here's what most people don't realize. The problem isn't only prices. It's how people think about saving in the first place. Picture a typical household in Ontario. 2 incomes coming in, bills going out just as fast. Groceries, mortgage, car payments asterisk, insurance. At the end of the month, whatever is left gets saved. Sounds responsible, right? Here's the problem. Usually, nothing is left. They're not careless people. They're not bad with money. They're simply playing a game that was rigged from the start. This is called saving with leftovers. It feels logical, but it almost never works. Now compare that to a wealthier household. Same province, similar income, sometimes even lower. Asterisk, but before a single bill gets paid, money moves into savings first, automatically, before it can be spent. That single difference changes everything. Researchers call this paying yourself first. It's not a clever trick. It's basic psychology. When money sits in your account, your brain treats it as available. Asterisk available money gets spent, slowly, quietly, without you noticing. This is why so many people earning good incomes still live paycheck to paycheck. It's not about how much they earn. It's about when they decide to save. Think about how this plays out across an entire decade. Asterisk 5% saved consistently barely builds a cushion. Asterisk 20% saved consistently builds real freedom. Same years, same effort, completely different destination. There's another piece almost nobody talks about. Lifestyle creep. Imagine someone gets a raise. Extra $200 a month. Feels great. A small reward, a nicer car payment, a subscription here, a few dinners out there, maybe an upgraded phone plan. Within months, the raise disappears. Spending quietly expanded to match the new income. The bank account looks exactly the same as before. Asterisk the raise never actually existed, financially speaking. This happens to almost everyone. It is not a character flaw. It is human nature. Marketing companies understand this perfectly. Asterisk they are not selling products. They are selling identity, status, comfort, the feeling of I deserve this. Every upgrade feels small in the moment, but added together, those small upgrades quietly eat the gap between 5% and 20% savings. So what actually separates people who save well from people who don't? It usually isn't income. Statistics Canada has tracked this for years. Higher earners often save a similar percentage as middle earners, sometimes even less. What separates them is structure. Picture two coworkers earning the same salary. One sets up an automatic transfer the day they get paid. Money leaves before it's ever seen. The other plans to save what's left. A year later, one has thousands saved. The other has almost nothing. Same income, completely different outcome. This is the biggest mistake most Canadians make. Waiting until the end of the month to save. By then, the money is already gone. Not stolen, not wasted on anything dramatic. Just spent in small, invisible pieces. Here's where things become interesting. The 20% savers aren't necessarily earning more. They are often just protected from themselves. Automation removes the decision. No willpower needed. No daily battle. This matters even more heading into retirement years. Many Canadians in their 50s and 60s realize too late that years of saving what's left added up to almost nothing. Picture a couple approaching 60. Decent jobs, decent income, but 30 years of inconsistent saving behind them. Now retirement feels uncertain instead of exciting. They imagine traveling. They imagine relaxing. Instead, they're recalculating numbers late at night, wondering if they've waited too long. This is not about bad decisions. It's about a system that was never designed to protect their future, until they redesigned it themselves. So what actually works? First, automation. Set savings to move out the same day income arrives. Even a small percentage matters more than people expect. Second, separate accounts. Spending money and saving money should never sit in the same place. Out of sight reduces temptation. Third, increase the percentage gradually. Start at 5% if that's all that's possible. Raise it slightly every few months. Small increases feel painless. Large jumps feel impossible. Fourth, protect raises and bonuses. When income increases, save the increase first. Let lifestyle catch up slowly, not instantly. Fifth, track progress, not perfection. One missed month doesn't erase years of progress. Consistency matters more than intensity. These steps sound simple. That's exactly why they work. Complicated systems fail. Simple systems survive bad months, busy weeks, and life's distractions. Think about gym memberships. The people who succeed aren't the ones with the most complicated routines. They're the ones who show up consistently. Saving money works the same way. Consider an investor who started small, just 5% in the beginning. Within 2 years, automation pushed that number past 15%. Not through sacrifice, through structure. No dramatic lifestyle changes. No giving up vacations or coffee runs. Just one decision, made once, that kept working in the background every single month. That's the real secret. Not extreme budgeting. Not giving up every small joy in life. Just removing the decision from your daily willpower. Saving 20% doesn't require a high income. It requires a system that removes emotion from the equation. This single shift, paying yourself first, is the real difference between feeling financially stuck and feeling financially secure. Because money isn't really about numbers. It's about peace of mind. It's about not lying awake wondering how next month will work out. It's about having choices instead of obligations, time instead of pressure, freedom instead of fear. The people who reach 20% savings aren't smarter. They are luckier. They simply build a habit most people never build. And that habit, repeated quietly over years, becomes the quiet difference between struggling and thriving. Think about where you want to be in 10 years. Stressed about every bill, or calm, knowing you're prepared. The choice starts with one small change today. If this video helped you see your own finances differently, that's exactly the point. If you enjoyed this video from Canada Finance with Daniel, don't forget to subscribe and turn on notifications so you never miss future videos. Drop a comment and tell me what percentage you're currently saving. And if someone in your life needs to hear this, share it with them today. Because the gap between 5% and 20% isn't about income. It's about the system you choose to build.